But today, yeah, as I already said, today we wanna have a look here at today's topic on the top 3 FX trading indicators we want to look at today. I want to give you some insights. And before we start, first of all, let's have a look here at Admirals and the rebranding. You probably have heard it. You probably have seen it. If you watched the website, if you visited the website over the last month, Admiral Markets is now admirals.com, or becomes admirals.com. And the rebranding takes place for a simple reason. This is already here in the next slide. So Admirals, or Admiral Markets initially started out as a FX and CFD broker with over 8,000 financial instruments, and establishing itself as a true leader within this financial service industry. And over time now, it became clear that there's demand also for other financial products and services. And in this context, we have the now rebranding taking place, where Admiral Markets becomes Admirals and is offering financial services like credit card, for example, beside all the other financial services you might have heard about, respectively, you might have already had access to. By the way, I'm talking and talking. I'm not sure whether I already shared my screen. That's probably a good way to do it here. So, yeah. So financial services, when it comes to CFD and FX trading, with here in Germany, for example, Admirals being known as the probably most competitive broker when it comes to FM, and not just FX trading, but also especially CFD and DAX trading. Here, known for a constant spread of 0.8 points for the DAX 30. Beside of that, it's probably noteworthy. That's not just the DAX expert we talk about. When here in Germany, as traders, we talk about Admirals as the DAX expert, but beside that, I also want to point out that Admirals has a highly competitive offering when it comes to FX trading. So especially for scalpers with very, very tight spreads, very good execution, very good and deep liquidity pool. Beside of that, there's also a great investment opportunity with Admirals Invest in this context via the MT5 physical stock. So there's plenty of financial products you have access to. Check out admirals.com for further information. And so we want to now have a look here at today's agenda. And I want to dig straight away and deep into what we want to look at. So today we want to look at the MACD, we want to look at the slow stochastic, and we look at the Parabolic SAR. It's short for stop and reverse. And I also want to give you some input, some insights, and how I love to combine number 1 and number 2 here. So the MACD and the slow stochastic. By the way, in around 1 month, so something like that, I'm not really sure. But I have also another presentation on an indicator I haven't now pointed out here, but there's also one I'd like to use, and I already want to let you know that we will shine a light on the relative strength index in the weeks to come in one of our Trading Spotlight webinars. So stay tuned for that. By the way, subscribe to the YouTube channel, set a reminder, respectively, check this notification box here in the top right corner on YouTube. Once you're watching this on YouTube, leave your comments below. If you have any questions, leave a thumb up here. The same is also true for all these people right now watching this live. Please ask all your questions if there are any, and yeah, feel free to shoot them over. I'd be more than happy to answer them. And so what we want to do now is, first of all, introduce here the indicator, in this case the MACD. And okay, and I want to introduce this MACD, MACD, but short is MACD in this context. So MACD is short for moving average convergence divergence. So you can already see there's some kind of convergence, or lines obviously converging and then diverging, and in this context then use this in some way. And as I want to give you an idea on how to use that. It's in fact known mainly as a trend following. 1 second, please. Great. Thank you. Thank you, Katie. I will download it right now, even though probably I won't now put it in the background. Leave it that way as it is right now. But use it next week. Thank you so much. Thank you so much, Katie. Yeah, so the MACD and it has a trend following, trend capturing momentum attitude to it. And it shows the relationship, in fact, of two MAs, which is short for moving averages of prices. So what it does is, in fact, it subtracts the daily exponential moving average 26, aggregation 26, and the exponential moving average 12 in this context. Very important, it subtracts them. So it's not a moving average of a moving average or something like that, but it subtracts those two from each other. And what then happens in addition to that, and you probably have seen those 26, 12 in the standard aggregation, there's a third number, which is usually a 9. So this 9 is the daily exponential moving average 9, which is acting in context of the MACD as a so-called signal line. So making triggers to buy and sell signals, which means like if it crosses higher than, or crosses above, then we obviously have a buy signal. Crossing from below, then we have a sell signal. And so this, well, all in all, sounds very theoretically. So I think it makes most sense here to give a straightaway example of an MACD chart to get a better idea. Yes, there's this is very interesting that you mean that. Before we dig deeper into this MACD now, there is a very interesting point made here by Vincenzo. It's the Hull MACD. So there's several can we call this derivatives? I think so, right? So it's like there's some adaptations you can make based on your personal needs and based on what you like to use in your trading. So all in all, don't get me wrong, it's usually I'm usually a big fan of using price action alone. But there are certainly also some aspects I'd like to take into account in part when trading part of my portfolio in a fully automated way. So which means that I have a portfolio and I've how can I say that, chunks of the portfolio, and then I say, well, this is the part I'm trading purely discretionary. This is the part I trade as an investment long term and mainly in physical stocks. This is a part of the portfolio I trade automatically. And what we now look at here is in fact the automated part. So most of my discretionary trading, in fact, is taking place purely price action based and mainly taking place in equities in this context. We will see, by the way, at the end of this presentation, once I combine the MACD and the slow stochastic here, we will look at an example where you can see that it's also possible to use this combination in Apple on an equity chart in this context. But still, it's noteworthy and important to note here in this context that if I'm talking about using indicators, most of the time I'm referring to the part of my portfolio here where I trade my where I trade my automated part of the portfolio. And so let's come back now to the example of an MACD chart, respectively. One final note. So yeah, there's certain and that's several derivatives of indicators. One is, for example, Hull. There's also if I'm not mistaken, Hull is also known for using kind of a rainbow chart, right? So having plenty of moving averages who work like a rainbow, respectively like a fan to some extent, if I'm not mistaken. I'm not really sure. So probably it's another Hull, or it's not even Hull, but this is definitely something I remember this name or connect this name to. But yeah, let's have a look here at the MACD chart. So what do we have here? Well, we have simple currency pair, Australian dollar JPY. You can use every other, but in this context, I'm using this chart as an example to illustrate my thoughts. And so what you can obviously see is the MACD here and this aggregation 12, 26, 9. So these are the three numbers again. Remember what we said in the slide before. So we have those EMAs on the 26, respectively on the 12. We subtract these from each other, get a number, and then based on that, we get, if you want, we get a histogram. And then we have our signal line. This is the exponential moving average 9. This is the red one here, which is then acting as our crossover line, if you want, to generate the signal. And as you can see here, within this chart, in a strong downtrend, obviously, here the histogram is negative. So obviously you have the EMA 26, respectively EMA 12, and the difference between those two being negative. So the histogram shows below the surface, below 0. And then you can also see that here the trigger line crossed below 0 and continues to trade below 0 until this downtrend is rather sooner than later broken. And this is exactly what's happening here. So to some extent, if you want, we are working really with a crossover system in terms of moving averages, which is quite well known here to trend following strategies. So once you get used to, or once you dig deeper into the topic of trend following and trend following strategies, what you usually find is that most of the time it will be introduced in some way with moving averages and their trend following attitude they normally have. And so yeah, this is in fact the example of a MACD chart. We could now certainly start to talk about divergences, which you can see here, for example, and how to use it as a signal line to trend and to capture trend moves in this context. But I want to show you in a later stage of this presentation how to combine two indicators here, how to use them for a quantitative trading approach. Before we do that, certainly, and if the slow stochastic plays a role here, we have to give the slow stochastic a deeper look. Okay, one sec. Let me just check something here. Yes, exactly. Daryl Guppy is used as a rainbow type as well. So there are several ways and aggregations here. So whole is rainbow, I think, if I'm not mistaken. Daryl Guppy here in this context is also using several moving averages, and all of them, to make long thing short, all of them are mainly trying to capture trend moves. So that this is what they are after. So usually these trend following, momentum capturing indicators aim to be to profit to try to capture trend moves, while they're not working well, not at all, to be honest, during range bound market or within market or range bound market conditions. In this context, sometimes probably the or let's say, yeah, significantly better. Relative strength index is probably even better than that. So again, we will have a deeper look into this in a later presentation in May. But once you plan to trade ranges, so this is very important to know before you use this for your trading in general. You wonder, well, does it make sense for me to use these indicators, which Jens is now presenting? I mean, Jens says, well, it works well for him. Great, but does it work well for me too? This is the question, and it's not. It does not make sense to just copy, for example, these indicators into your trading without really knowing who you are and which strategies you perform well in, respectively, which strategies you correspond well with. So, which means, like, if you, let's say, if you're a range bound trader, well, then you will have trouble to use the MACD or also the slow stochastic here in a profitable way in your trading. While if you're a trend follower, or if you're a momentum trader, if you're a breakout trader who aims to capture bigger breakout moves and stronger trends, then certainly these make definitely sense to your trading. That's something which is probably of high importance, and which already shows in which direction my trading points, in fact, and what I'm looking for when trading the markets. So let's come back now to the slow stochastic. So the slow stochastic here is also a momentum indicator. So obviously I'm combining momentum and trend following indicators like the MACD with a momentum capturing indicator like the slow stochastic. That makes the most sense. And here in this context, we can say as an oscillator is defined, it's range bound between 0 and 100 by default. And it shows the location of the close relative to the high-low range over a set number of periods. So, and in case of the stochastic, there are two lines which we used. It's the slow oscillating percentage K line and a moving average of the percentage K line we refer to as percentage D. By the way, one thing right at the beginning here, when it comes to the stochastic, the SSD in this context was in fact the first indicator I ever used in my trading, and I never got rid of it. So I always looked at this in the indicator and continued to look at it when it came to quantitative trading approaches, which is kind of interesting because well, I'll put it differently. So I didn't really know who I was when I started trading. So I didn't really know whether that makes sense to me or not. It just looked good. And so I thought, well, probably makes sense. So I use it in my trading. And then I adopted it and I used it in a way so that I correspond well with the indicator. That's probably also interesting when it comes to other indicators. So you might probably wonder, well, are there other indicators out there? Yes, plenty. Tons of indicators, hundreds, thousands indicators. You can find your own aggregation. The interesting thing is now, and this is true for many trading approaches. It's like there's some. It's possible that the standard aggregation in an indicator or the indicator in general does not fit your personality, and thus you do not perform well with that. That doesn't necessarily mean, or that doesn't mean at all, that the indicator does not work. It just does not work for you. And this is something to keep in mind here, and something to remember. Yeah, small story at the here as a side note here, that the slow stochastic was my first ever used indicator. And so here again we have the Australian dollar JPY again on a daily chart, and again same aggregation with, as you can see here, not the MACD anymore, but here now with the slow stochastic. In this context, by the way, what you can see is it's the, I'm not really sure whether this is the standard aggregation 533. 533 is very short term. It's very short term, and thus especially interesting for intraday trades. Even though I once used it, not in this case, as you will see, but once used it in an aggregation of 15.55. That was what I used it for. And why I used it for that was because I was more kind of a swing trader at the beginning. So I didn't really try, or wanted to focus on intraday trades, but it was more like trading for several days, and thus trying to capture swing moves in my trading. And that was also something I'd like to share with you here. Why is that? Why did I focus on swing trading at the beginning? That was because I didn't have the time. I studied. I had to go to university back then, and beside of that, I had also a job as a trading assistant. So I had to. I mean, I traded for a living as a professional trader on a trading desk, but it wasn't that I traded my own account actively, or that I had the time and the focus to trade the account actively during that time. And then thus I had to find ways how to make sure that my overall trading frequency was not so high that I had to focus too much on my trading, but it was more like I tried to really reduce the trading size, respectively, not size, but frequency, the frequency of my trading here. And thus I used a longer aggregation, let's call it, or a longer term perspective I was focusing on. However, so when looking here at the, by the way, I'm sorry, this is, no, that's bad. No, it's not the, 1 second, please. It's not the MACD, it's the SSD chart. I didn't change it here. So 1 second, please. Let me just go back. Okay, 1 sec. So now present again. So there we go. So it's the slow stochastic chart. And as you can see here, as you can see, for example, there's some periods of extension on the upside, respectively extensions on the downside, which you can, for example, spot here, which are then pointing to short-term tops, which is especially true once here you see the crossover from this blue line down to the below this dotted line in this context. So which means like the percentage K line is in this the percentage K line is crossed by the percentage D line, and in this moment here. And so also here, this is not something special or something holy grail like secret whatever, but it's just an introduction of what is the slow stochastic. Before I now show you how I combine these two and how this could also be then used, for example, in equities trading, and especially from an automated trading perspective, I first of all wanted to share another indicator I highly appreciate in my trading, even though I have to say that it's a personal taste thing. It's like, I mean, you could also use another indicator here. For example, one I use in my discretionary trading. I'm not using the parabolic stop and reverse in my parabolic stop and reverse in my discretionary trade. I use it in the automated part, while I'm using the super trend indicator, for example, in the discretionary approach. Both are very, very similar. And in fact, as you will see here, the same is true. You only have to exchange the wording and the calculation, obviously. The parabolic stop and reverse, or SAR for stop and reverse, is a trend indicator. But, and this is special about this parabolic stop and reverse, it's also all in all a complete trading system, which is not just showing where a trend potentially starts, but also where it potentially ends. And this is something where also the super trend indicator, for example, could be used. So you can find a super trend indicator in the MQL4, MQL5 community. So there's plenty of exits to this. And what I usually do is I use this as a stop line. Yeah, that's probably the right way to put it. So when I, for example, trade a breakout in the DAX, let's say based on the open range, you see a strong move in one or the other direction. Let's say it's a long trade. You see strong push, strong drive on the upside, and the mode looks very extended. Now the thing is that here there's a differentiation. Let's put it that way. So first, you have the possibility to say I'm working with a predetermined take profit level on the upside or on the downside. In our case now, the example is the upside. You say, okay, I have a move strongly in my direction, but my take profit wasn't hit. So what do I do? Do I bet on the market continue to trade on the upside and probably overshoot even my take profit? Or do I really want to risk that the market now pulls in and takes back most of my gains? Then me hoping that somehow the market turns around and finally pushes to my take profit region. And to get rid of this problem, I'm using then the super trend indicator, for example, trail my stop via the super trend indicator, and then see whether we are continuing to trend higher, and I probably get a chance to trail my stop even beyond my predetermined take profit level, or if I'm getting stopped out, but have at least part of my gains secured that way. That's one way to use it. The other way is to say, I'm not working with a predetermined level, but I have a strong opinion based on, let's say, the overall picture in the market I'm trading. Let's say in the DAX, you see the breakout in a long direction, and it's close to a significant resistance on the upside. And if we break above that resistance, then further upside is to be expected. And then I don't want to have a take profit closely to this resistance zone, but I'm more kind of betting on the breakthrough and hopefully capture a stronger trending move then beyond that level. And then I have to find a way to trail my stop based on a certain calculation, a certain formula, which is also connected to the overall volatility in the market. So this is what's special about the super trend indicator. In case of this parabolic stop and reverse, this is again for the automated part of my trading. But wait 1 second, please. I just have to Okay, I just have to check my screen here on the right way, because we have 1 minute to go for our the US market opening. And why do I focus on US market opening? What chart did I just check? I checked the chart from Facebook. You've probably seen that Facebook had some strong earnings, and yesterday wasn't really capable of continuously trading significantly higher. But what was certainly interesting was that in the afternoon, respectively our evening, the stock then traded back to its daily highs that day, and that was, especially in the market environment overall, the not very strong environment in which we found ourselves yesterday. That was a sign that probably there's further upside to be expected. That depends a little on whether we can now make it above 330, but still, this is something I have to focus on today, then in the afternoon. And yeah, so this something I'd like to let you know here, why I had to check the, oh, this is interesting. What happened here? Why I had to check this chart. Oh, that's interesting. Okay. So, but now let's focus on here on the logic behind the parabolic stop and reverse. It's quite simple, in fact. As you will see in the chart in a few seconds, once the dots here are below the candles, you are long, and once the dots are above, you are short. Simple as that. So no big surprise here. So as you can see also, again, and that corresponds well with my personality. So I'm a trend trader. I'm a breakout trader to some extent. I'm trying to capture momentum moves in one or the other direction. And thus it makes sense to look at an indicator like the parabolic stop and reverse, as it makes sense to look at an indicator like the super trend, also focusing not just on the trend, but on the overall volatility, and would calculate the indicator being calculated on that. On this volatility breakout momentum move and this directional push away from price in this context. And as you can see here, in range bound markets here, you get a buy signal somewhere here within this region. So this is very interesting to know that once the price hits the point, you can say the position switches. So it's from long to short and the other way around. So here, for example, you can see that you are in the position, let's say from this moment onwards here, whatever price that might be, this is where your initial point starts. And here, the dot, in fact, is the moment where you have the stop, the initial stop. And then the market moves, obviously, in your direction, and you trail the stop as long as we are not seeing a stop out in this context. So it works perfectly fine in trending markets. As you can see here, especially once you capture such a strong move, then you can capture most of the move and don't really care about how much the market retraces, in fact. So what you do is you say, I have a parabolic calculation based on which I decide where to put my stop, where to enter the market, where to place my initial stop, and so on and so forth. And once I'm getting stopped out, it's not just that I'm getting stopped out, but I switch the position from, in this case here, for example, short to long in this context. And so if you have, and this is something which is important also, if you have strong trending markets, or let's say volatile markets especially, what's very interesting in this context is that these indicators work perfectly fine and perfectly well, but there's also, let's call them calm markets, or markets where you do not have lots of volatility, currency pairs especially. So I was referring to the DAX, for example. Why the DAX is of interest for me as an active trader? Well, because of the high volatility and the strong moves on the up and on the downside, and the erratic structures sometimes from time to time. And when it comes to FX trading, these moves tend to occur lesser and lesser. Right now, the market environment switches to a very calm state. This is one main reason for that is because around the globe, there's more and more quantitative easing from central banks to support their respective economy. pushing yields lower, 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 lower. And the main problem when it comes to volatility is that volatility is usually directly correlated to the yield differential between two currencies, which means if you have one currency and the yield level of 0 and the other with the yield level of 0.1 or 0.2, well, there's no differential and there's no real volatility or something picking up, which is a big issue right now. And one of the reasons why, for example, in the current environment, especially with this low volatility environment, the parabolic stop and reverse has some trouble. Again, it depends a little on the market you trade, on your personality, the market you trade. Once you say, yes, I'm a trend follower, or I'm trying to capture momentum moves, and I do this, obviously, in a market which delivers strong trending momentum moves, momentum markets, well, I'm fine with working with such an indicator here, like the parabolic stop and reverse, especially from a trailing stop perspective. So to trail my stop into the direction of the respective move then. So, and finally, we now come to the point. We come to the point now, one sec, how I combine these two indicators. So the MACD and the SSD, so the slow stochastic in this context. And as I already pointed out, and what became clear so far, I think, the stochastic oscillator is a momentum indicator, while the MACD is also a momentum indicator, but mainly a trend following, trend capturing momentum indicator. And so what we now aim to do is, and what my idea behind my trading approach with this is in fact that I try to bring both indicators together and capture the meat out of both of them, or try to use one advantage and the other advantage and make 1 + 1 greater 2. So, okay, you see the idea behind this. So it's what I'm aiming on is, in fact, I'd like to formulate an approach where we get a trend confirmation strategy in this context. And here, the key parameters of the MACD slow stochastic double cross strategy, so this is how I call it in this context, is that what I do is I use the standard aggregation in the MACD, so 12, 26, 9, and the slow stochastic then in a slightly derived, yeah, I think derived, no, derived is the wrong word, adapted way from my initial. You remember I talked about slow stochastic first indicator. I'm trying to focus on swing trading strategies 15.55, and then over time and do back testing, I found out, well, obviously 14.44 is a slight better use or aggregation for the slow stochastic here if I combine it with the MACD. And what I then do is, in fact, I formulate a long scenario, for example, here based on the fact that I say, well, if we have a bullish MACD, so what is a bullish MACD? I already told you that, but let's repeat it again. This is once we have a histogram, so the difference between the EMA 12 and the EMA 26, which is greater 0. If we have a histogram of greater 0 and the MACD line is crosses above 0 in this context, so this is the EMA 9, and this is an and which includes, so it's not that it's an and or, but it's a and here, and a slow stochastic here of 14.44, so in this aggregation, where the percentage K value passes the percentage D, so the crossover taking place. What we do is we enter the asset on the opening price of the next appearing candle, stop below the last identifiable candle in this context. So in this context, we could also, once you say, well, to fully automate this, we could also, for example, take the slow stochastic, parabolic calculation to place the stop here. I place the stop accordingly. But however you do that, what you usually do is first opening price of the next occurring candle. If this long setup scenario is given here, you can also, by the way, adapt this and use a short setup the same way, only mirror it, let's say. And then you place the stop below the last identifiable candle, usually below the consolidation, which takes place. And so what we have here now is this equity example. It's the Apple example. 1 second, please. Okay. So what I have here, obviously, I mean, it's a perfect example. What should I say? Usually, this is usually something I don't like. Using an example which looks so perfectly fine in this case, because it's not really something I well, obviously it works. Let's put it that way. So you look at the chart and you just look at it and just say, yeah, great, works. Seems to be, well, works perfectly. Obviously it works here, especially in a stock like Apple, but there's plenty of other stocks where it currently works perfectly fine with this strong bullish momentum we've seen here. But I took this chart as an example to point this out. By the way, you can see this is an older chart. In fact, it's from 2020. That was before the split took place in Apple in August. So the stock is now trading around 130, I think 130, 140. 1 second, let me just see. Where do we have it? Yeah, 132. Yeah, 132. So, and as you can see here, this is the combination. So we have the slow stochastic, okay, with this 1444 aggregation. We have the blue line crossing above this orange dotted line in this context. So the percentage K value, percentage K crosses above the percentage D. And why are we long here? Because the second scenario with a positive bullish MACD histogram, respectively aggregation in general, where the histogram is positive and here the EMA 9 is trading above 0. So the 0 line here is the dotted one. Probably that would have been better if we made it a little blue or something like that, or red, whatever. So that's the reason why we are having a position here. And as you can see, first strong trending move. Here's the second. As, by the way, you place the stop below this aggregation. There you have a consolidation. You keep the position as long, by the way, as you keep the position within this period here. So it's not a new signal, but this is the exit signal. Very important. I just realized that I only told you how to get long. Just see here, long scenario. But the question is, okay, when do we close the position? That's something I missed here. So it's important to know the exit out of the position happens once the percentage K drops back below the percentage D in this context. So which means you're capturing this move, and then you're out of the trade again. Same here. You enter the trade because you're trading in positive territory in the MACD. You see here, percentage K crosses above percentage D. You have the long signal, and you keep the position as long as the percentage K is not crossing back below percentage D. Same is true here again. So what you now need to do, that's a miss trade in this context, by the way, here. So here you enter, and then you're getting stopped in this context. I have only positive signals here right now, but you could also find ways here, for example, quick in and out move. Well, yeah, at least part, you're capturing part of this move. You can already see it's quite active. So it's not this daily chart, so which means we are here, don't have to focus on that on a minute time frame, but you can see that you're still having a quite high trade frequency in this context, which is one of the reasons, which is perfectly corresponding with the swing approach I was just talking about earlier. And here you can see then a very strong trending market movement where you have the crossover, and then here you keep the position. In fact, it's as long, it seems like there was a crossover, but it's not really taking place the whole time. Here the blue line was trading above this orange dotted line, and this is where you exit the position. Then in fact, even if you have a signal here which tells you that there was a crossover, you have a re-entry once we see a slight push back above that level again. So and you would still would still work perfectly fine in this context, and you try to capture most of this momentum move and trend move here. And yeah, so that's the example in the real world, in fact, which brings us here to the summary of this presentation. So what we have is the top 3 FX trading indicators I just presented to you. It's the MACD, slow, stochastic, and parabolic. All of them are trying to capture trend following moves. Trend following is very important once you're a trend follower, or the trend following indicators are very important once you're a trend following trader. That is something which needs to be discussed before you start to use an indicator. So which means you have to really ask yourself, who am I? What kind of trading I want to focus on? What do I try to achieve with my trading? And if you have answered this question, you can then start to look which indicators help you to achieve your goals and your overall or satisfy your needs as a trading personality. That's probably a better way to put it. And so here, when we look at the combination, we have the MACD and parabolic stop and reverse trend following approach, trend capturing momentum indicators, as pointed out. We have the slow stochastic as a momentum indicator. And what I like to do is I'd like to use the MACD and slow stochastic here in the trend confirmation strategy, as shown earlier in this presentation. And yeah, that's on a quite technical topic today. Don't forget to join us next time. So we will have a look here at the ARC Innovation ETF from Cathie Woods. Some of you probably, Cathie Wood, sorry, it's Cathie Woods, ARC Innovation ETF, and it's Cathie Wood. You probably have heard about her. She's covered, yeah, she's a celebrity right now, and covered in all big financial media series or whatever. And what is so special about her will be topic of this hot topic webinar on Wednesday. And we will first of all introduce Cathie, and I will tell you who is Cathie Woods. Who is Cathie Wood? I'm sorry. Oh, wow, I have to learn that. What's ARC? Okay, and especially what's the ARC Innovation ETF? ARC is in fact the whole company, in fact, and they have more than just the Innovation ETF. So for further information, just Google Cathie Wood and ARC, and you will see that there's some further input being found, which is highly interesting. We want to have a look here at the top 10 holdings you should have on your trading watch list too. So mainly growth title, Tesla, certainly Roku. Also T-Doc, for example. So we will shine a light on all of these. And then at the end, you will get, again, my top 3 out of these top 10 holdings. As you probably have guessed, well, Tesla's on it. Okay, we had a webinar on electric vehicles earlier this month. So obviously Tesla will be on it, but there's also another 2 I'd like to point out here, which are of high interest. And yeah, when will it take place? Next, is it? Oh, I'm sorry. No, Wednesday here. So it's Wednesday, 5th of May, next week, Wednesday, 2 p.m. London. And if you've already registered, check your inbox for the webinar link. If not, watch this on YouTube. If you watch it here and you haven't registered yet, head over to admiralmarkets.com. And there on the educations and webinars tab, you can see the upcoming webinars, and here register for the upcoming one on the 5th of May. On Wednesday here on Cathie Woods ARC Innovation ETF. And for further information, check out not just the website, but also contact Admirals directly via mail, via the YouTube channel, and hear the risk disclaimer. So all the best. Happy trading. Watch your stops. See you next Wednesday. I look forward to it. All the best. Bye-bye.